Hello, this is Eric Parnell, Chief Market Strategist from Great Value Advisor Group, and I'm joined once again today by Evan Coffey, Investment Analyst from GVA. Evan, how are we doing today?
We're doing well, Eric, and it's great to be back on another edition of Market Insights here at GVA, but I have to say I'm feeling a little bit of deja vu, and it's not in a great way. It's February once again, and tariffs are back in the news. Last Friday, the Supreme Court ruled that President Trump did not have the authority to unilaterally impose the tariffs that he did under the International Emergency Economic Powers Act, or IEEPA. With that being said, half of all import taxes of the US government each month come from those IEEPA tariffs. But following the ruling, the president was quick to address the general public at the White House and basically say that he, A, strongly objected the outcome, and B, that this would just simply be a bump in the road. He followed up the ruling by announcing a new 10% global tariff under the Section 122 of the Trade Act of 1974, which allows him to impose a 15% baseline tariff, or up to 15%, for no more than 150 days. So definitely more strings attached than the IEEPA tariffs, but even still, the tariffs as of now will remain in place. The majority ruling did not answer the question, though, that many are asking about whether companies will be paid back for the, call it 135 to 170 billion in tariff revenue that is being collected by the US government. High level, that's what happened on Friday. There's plenty more details about the justice's comments and everything else that took place following the breaking news. But I'm going to get into what this means for us as asset managers and for what it means as you as investors. To start, without IEEPA tariffs, consumers face an average effective annual tariff rate of 9.1%. If those IEEPA tariffs stay in place, this number moves to close to 17%. If IEEPA tariffs stay in effect, the goods being tariffed basically become food and apparel. If they are wiped out, it's electronics, metals, vehicles, really goods that don't pertain to the average consumer. So consumers, just from their perspective, it would be good for these tariffs to be ruled against. As for the market, we saw quite a bit of froth on Friday, but VIX levels stayed below 20 and all major indices ended the day higher. So what I'd like to get your take on, Eric, is first, was the generally positive market reaction because retail and institutional investors truly believe that there will be a lower effective tariff rate? And second, I'd love your thoughts on how this plays out, given that the president has already come up with a backup plan to establish tariffs in a new way.
No, it's a great question. It's going to continue to be an ongoing issue. I think the bottom line is that the tariff game is over. The Supreme Court ruling really took away Trump's primary tariff weapon, which was the IEEPA authority to basically administer tariffs at will. That ability has been stripped away. Is there the opportunity for the administration to resurrect those tariffs through other channels? Absolutely. But it's a much more arduous and cumbersome process. And one of the challenges that the administration faces in trying to do that is that there's going to be a tide rushing increasingly in the other direction. With the Supreme Court ruling, it's only a matter of time before people start pushing back from a legal perspective. They start looking to get their money back from the tariffs that were instituted. It's the sword has been dulled, I guess is a way to think about it. The only problem from the market's perspective is that the damage has been done. The damage has been done to the economy in terms of not necessarily higher inflation, but it has had a meaningful effect on affordability. The prices for goods have become higher, and the availability of goods have become more scarce as a result. Those factors are likely to continue because there has been a tariff impact that's going to persist. The other factor as well is that it's going to continue to breed uncertainty and volatility because that noise is going to continue. We have the tariffs that were put in place that are going to the 10% tariffs, the 15% tariffs that'll be in place for another 150 days. And that saber rattling is likely to continue into the summer. So it's something that's going to keep the markets on edge. But the real punch from it is likely diminished at this point.
Well, and do you think that overall we will see a lower effective tariff rate coming out of this, and that's why we had the positive reaction on Friday?
Absolutely. You take away that tariff threat, The reality of it is that the elimination of the further tariff threat. I mean, the tariffs that are in place, some of them are going to stay in place. We're talking about higher goods costs, higher imported goods costs, and that's likely to stay. But the fact of the matter is that with the future threat diminished, that helps improve the corporate profit outlook due to a lower cost of capital, due to increased profit margins. So on net, it's positive for the markets, but it's going to take time for it to diffuse its way through because of the continued uncertainty.
Yeah. Well, let's stick with politics and their effects on financial markets. Let's talk about the state of the U.S. economy and specifically President Trump's State of the Union address last night. One word I would use to describe it was patriotic. From Chance of USA to the United States men's hockey team coming out with their gold medals, there was no shortage of national pride. Whether that was on both sides of the aisle, I'll leave that up to the audience to decide. But while this was all well and good, I want to discuss some of the topics that President Trump addressed directly. The tariff situation was obviously the elephant in the room. However, he kind of just bumped right over it. He obviously said that he was disappointed in the ruling, and he was clear to state the tariffs would stay in place, as I mentioned previously. His solution, in his words, was even stronger than before, and he harped on the fact that he wouldn't need congressional approval for these tariffs. He also mentioned that these tariffs would be paid for by foreign countries, which we have not seen up until this point. But we covered tariffs already, so I want to get into, he also addressed the topic of affordability and used anecdotes within healthcare and housing as to how he's made the United States more affordable for the average consumer. But when addressing the word directly, the so-called affordability in question was immediately pawned to the previous administration and those who voted for the policy under the previous administration. A variety of other topics were addressed, but I think it'd be good to simply just take a look at the raw data of where we are and where our economy stands today compared to a year ago. Starting with growth, US GDP for the fourth quarter came in rather low and rather unexpectedly low at 1.4%. Analysts were expecting around 3%, but it should be noted that there was a government shutdown in the fourth quarter that could have affected this. For the year, the U.S. economy grew at 2.2%. This is compared to 2.8% in 2024. As for unemployment and inflation, the current unemployment rate sits at about 4.3% as of January 2025. It was 4% in January of 2024, moving into 2025, 4.3% in January of 2026. PCE, the Fed's preferred measurement of inflation, currently sits at 2.9% with core at 3%. It was about the same at the start of 2025. So my question to you is, A, what were your takeaways from the State of the Union address? But B, simply looking at that raw data, what do you feel like the state of the U.S. economy is?
I'll answer the second question first because these are both good questions. U.S. economy continues to be solid. The fourth quarter GDP print was a little bit light, but I wouldn't be surprised if we see some upward revisions on that as we go through the future prints to get to the final number. You look at the fundamentals, growth remains strong. The unemployment rate remains relatively low. Inflation pressures remain in check. Corporate profits are growing at a double-digit rate. I mean, what's not to like when you take a look at those basic fundamentals? But the real story resides underneath the surface. And, we saw it during the State of the Union address, which, frankly, is an infomercial for the party that's in power and also an opportunity for the party that's not in power to rebut. And there's always things that could be, lauded and criticized associated with an address like that on either side. But there's a fundamental problem that's confronting the U.S. economy and, politicians on both sides of the political aisle as we go through 2026. And we're hearing that differentiation in terms of the dialogue around inflation and affordability. Yes, the inflation rate remains in check. We continue to see a kind of a leveling of inflation, that inflation outbreak that we had in 2022 that has largely gone away. But here's the problem, and it's that differentiation between inflation and affordability. Inflation may not be going up all that much, but the issue that consumers are running into right now in this economy is that things got really expensive a few years ago. And yes, inflation might have fallen to between 2 and 3%, but that means things got really expensive a few years ago. and they're continuing to get marginally more expensive, maybe not rapidly more expensive like they were in 2022, but the fact that we still have inflation means that prices got high and now they're continuing to rise. And that is the agitation that we're seeing among consumers. That's the drag that we're seeing on the economy. And that's part of the reason that we're seeing, the issue that voters are being confronted with. There was an opportunity last night in that address on both sides of the political aisle to address that affordability issue, because that is really at the heart of voter consternation right now and the drag on the economy. But here's the fundamental reality, and this is going to be something that is going to be a problem for the U.S. and arguably for the rest of the world, but for the U.S. through the remainder of the decade into early next decade. There is no fiscal discipline anymore on either side of the political aisle. We have a budget deficit and debt that continues to increase in this country, and the solution to an inflation and affordability problem is not tax cuts. It's not increased fiscal spending. This is Econ 101. You want to get an inflation and affordability problem under control, you got to raise taxes, you got to raise interest rates, and you got to cut fiscal spending. And nobody on either side of the political aisle is even willing to talk about that right now. As long as we lack that discipline on the fiscal policy side and the monetary policy side, this problem is only going to get worse, and it's going to continue to be a drag on the economy.
Yeah. Well, you certainly know how I feel about the fiscal deficit. I've wrote about it before, so I'm glad that you addressed that. I want to move on to our final topic today, and something that I think has been the biggest story in financial markets to start the year, and that is the technology and tech-adjacent sectors stumbling out of the gate. We've seen software stocks be pummeled over fears that AI will commoditize the industry. Suddenly, investors are now worried about valuations, and financial media is, printing headlines like the AI trade is faltering and will tech sustain its rally. And many retail investors are now questioning whether their high-flying investments of 23, 24, and 25 can remain the powerhouses that they were for equity markets. All major indices were down more than 1% on Monday, with many attributing the drop to a doomsday article out of Citrini Research. The article, which you and I both talked about, detailed a dystopian market where AI and tech falter, and investing is an uphill battle for the rest of the decade. But once again, rather than focusing on the headlines and what I believe is a little bit of fear-mongering, I want to focus on the facts. At the time of filming, the S&P 500 is basically flat on the year. The Dow is up about 1.5%, and the NASDAQ is down about 1.5%. On the flip side, the equal-weighted S&P as measured by the RSP ETF is up about 5.5%, and small caps as measured by the S&P 600 are up more than 8%. You have sectors like consumer staples, materials, energy, industrials, all having positive starts to the year, with some punching double-digit gains. So I know that you have strong opinions on the narratives in equity markets right now. And my question to you is, do you think we're entering this doom and gloom, equity investing period where tech and the equity markets crumble, or is the reality that there are just opportunities now outside of technology and artificial intelligence?
No, this is a market to be excited about in 2026, but not for the reasons that we've been excited in 23, 24, 25. So let me start on the side of the things that investors need to be wary about. For the last 4 years, really going back to October of 2022, it's been a market that's effectively gone straight up. Have we had a few speed bumps along the way? The summer of 2023, the spring of 2025, absolutely. But on the most part, this is a market that's wanted to go relentlessly higher, and for good reason. We've had strong economic growth. We've had moderating inflationary pressures. We've had double-digit corporate profit growth. It's textbook. Stock market should be going higher. But part of what had been driving the market higher from October of 2022 and really since the summer of 2023 has been this AI boom. And it was a party. And everybody that even mentioned the acronym AI was invited, and your stock prices were going to double, if not triple, as a result of this euphoria about how AI was going to change the world. And it is absolutely going to change the world. But it doesn't mean that we're going to see it continue in stock prices indefinitely, because there is a transformation that's taking place, and we've been seeing it unfold since the fall, and it's only likely to accelerate in 2026. Because the AI boom is now turning into an AI arms race. Because up to this point, Companies have been racing to get their AI footprint out there, but now we're at a point where companies that we're going to start to see winners and losers. There is a recognition among companies that want to participate in this next evolution of technology that they need to spend and borrow money and spend more and continue to spend in order to survive. There's going to be tech companies that are at the top of the heap that are going to be part of that next generation of AI winners, but there's also going to be names that we know really well now that are going to be part of the losers. And the market is starting to rationalize that now. So one of the things we should expect as we go through 2026, if you've been riding that tech wave, that wave might start to crash onto the shores a little bit. There's some names that'll continue to do well. There are others that might struggle a lot that we're not accustomed to for a long time now that might really start to struggle as we go through the rest of the decade. Now, one of the things that's important to remember, and you did such a good job of highlighting it in your points, technology is only one of the 11 sectors in the S&P 500. Communication services is a close partner to technology. You also got consumer discretionary that's got some pretty big names at the top that are also tech related. But you get to the other 8 sectors, they have been effectively left behind for the last 3 years, with very ho-hum lackluster performance. One of the things we've seen since October, and I suspect that we're going to continue to see it, areas of the market like energy, materials, consumer staples, healthcare, financials could do very well in the market environment that we're operating in right now. Even industrials could do really well in the market environment that we're operating in right now. Just because tech isn't winning doesn't mean that the rest of the sectors can't do fantastically well, because they have been on fire the last few months.
Yeah. Well, it sounds like generally you're constructive on equity markets. Maybe the investment within technology and tech adjacent sectors needs to be a little bit more pointed. Winners are going to be differentiated from the losers, but then there's also opportunities outside of that. So Eric, it was great talking to you today. I think we covered a lot of ground. I think that there's a lot going on in financial markets, a lot going on in politics. It's great to be with you.
Evan, it's always great to talk with you. And as always, as we always talk about in these market insights, in the volatile markets like we're likely to experience in 2026, it all goes back to the key fundamental principle of investing. Remain broadly diversified, seek opportunity, and stick to your long-term philosophy. I'd like to thank you for joining us for this latest market insight, and we look forward to seeing you again soon.